Welcome to my Accounting 1110 last discussion on the topic of investments, where my goal is to evaluate the performance of the company using the ratio return on total assets, also known as the ROA. This ratio evaluates the company's ability to generate profits. Remember, as an investor, you can invest in a business in one of two ways. You can invest in their debt, or you can invest in their stock. Either way, you would like to see how well your investment's performing. Going back to what we learned in Accounting 1110, we publish annual reports and financial statements to outsiders or external users. You can word it either way. And they take these financial statements and they analyze them to decide if they want to invest in our debt or our equity. We can finally say it that way. So let's look at how you use the formula return on assets to evaluate how a company is doing, taking their assets and generating a profit. The formula is to take net income plus add back any interest expense and divide that by total average assets of the company you're evaluating. Remember, anytime you use an income statement number in the numerator, you generally average the balance sheet number, because the income statement's a period of time and the balance sheet's a point in time, so we average it. And what that tells you is that for every dollar that your investee has tied up in total assets, how much net income are they able, how much net income with interest added back per dollar. So for every dollar you have invested in total assets, how much net income are you able to generate? And the reason that we add back net income is to determine the real return on assets, regardless of the way the assets are financed, whether it's through debt or equity. Now, the real benefit to a ratio analysis, as you recall, is looking at a trend where you look at their year-to-year return on assets. Are they doing as well as last year or not as well? And to do industry comparisons. How do they do when compared with people in the same industry? A ratio taken by itself doesn't mean much, but when you take several ratios for a period of time and compare it to your outsiders, you can get a feel that makes you feel warm and fuzzy or cold and prickly. Should you invest in this stock? Return on assets is a perfect ratio to look at in an investment chapter, because you're taking net income and dividing and comparing it to the average total assets that your investee has. So the investor is looking at the investee's financial statements, take their annual report and look at it, run this ratio on it and see how they feel about it. You know what? It's Christmas Eve and I need to stop getting a little carried away with pen casting. We'll take this up in the new year. Happy holidays if that applies to you, and if not, it does to me. See you later.